Welcome, everyone. I'm Ted Earhart. For months we've been hearing that mortgage rates are at all-time lows and, it's a great time to refinance and so forth. That's really been the case since the pandemic came online and the Fed pushed rates all the way down to their key interest rate is basically at zero today. Mortgage rates follow lower. But anyway, a few months ago, actually, I think it was in the May-June timeframe, although mortgage rates were at historic lows then, I proposed that it was probably a good probability that we would see mortgage rates continue to trend lower. And it all has to do with this key interest rate relationship, which you're looking at up here on the screen. And I'm not going to go too deep into this, but here's really all you need to know. The 30-year mortgage is graphed in this orange or tan line on top, and it's graphed against the 10-year government bond in purple. And there's a reason why this relationship exists, but that's beyond the scope of our discussion today. All you need to know that it does exist and that it stays pretty steady over time. On the very bottom here, what we're graphing out is the difference between these two key interest rates. And over the last 20 years or so, the difference between those rates has been about 1.8%. So if the 10-year treasury, is at 2%, well, on average, the 30-year mortgage has been about 1.8% above that. So that would give you a 3.8% mortgage rate. But every so often when the financial markets gets crazy, this relationship kind of breaks down. And that's exactly what we saw earlier this year in March. In fact, in March, you can see the spike on the interest rate spread back at the time where it was moving towards 3% and in the direction of nearly twice the long-term average. So based on that, mortgage rates were actually rather high, even though on a nominal basis, they had moved towards their all-time lows. The purpose of my discussion today is just to mention that kind of week by week, we've seen mortgages start to catch up with the 10-year government bond and move back towards the normal long-term range. It's still a little bit on the high side, but it's much closer to where it, quote unquote, should be. I think this is important because there's another current event that I want to mention. On December 1st, the big mortgage giants, Freddie Mac and Fannie Mae, they are instituting a 0.5 percentage point fee on top of all new mortgage refinancings at that time. They're basically saying that, look, there's increased risk out there because of the challenges in the economy, of course, given the pandemic and so forth. So we need to price that risk into mortgage rates. They were going to do it, I think, on September 1st, but they got a lot of public backlash. Obviously, that people felt like the mortgage giants were gouging people right in the midst of this pandemic. So they pushed that back to December 1st. And my point is, if you want to avoid this 0.5 point fee, your window of time for doing so is narrowing. A 0.5% on a $250,000 loan, for example, is $1,250. So if you can get your refinancing done prior to December 1st, you might save yourself some money. Anyway, so I wanted to circle back and talk about kind of where this key interest rate spread is in case some of you watched my video several months ago and have been waiting to see if rates have trended lower back to the normal range. And the answer is yes. So now is a much better time, given this key long-term historical relationship to refi relative to what it was just a few months ago. I mean, as you can see, it's certainly possible we could see rates continue to move lower. That's no guarantee, of course, but I think I just wanted to bring this up again because we also have this fee hike coming down the pipe on December 1st. So that's just a quick one for you today. If you're thinking about refinancing, now is probably not a bad time to do it whatsoever. So thanks for tuning in, and we'll see you next time.